This video is targeted directly to property investors based in Australia. We've all been going through a lot of hurt at the moment in the property investment space. Everyone's gone through 13 plus rate increases, and there's a lot of hurt out there in the market right now. But the key thing is a lot of property investors have a lot of big goals and want to achieve those goals, right? But right now versus any other time in the Australian lending history, it's tougher now than it was ever back in the day to get more investment loans and to build up a property portfolio to achieve your dreams and your aspirations and where you want to be in life. So stay to the end of this video and I'll make sure I will add a lot of value to you and your property journey. And let's go through these slides now. So what is a property investor's biggest pain point right now? Is it finding the right broker? Is it finding the right property? Is it finding the right location? Finding the right accountant? I don't have a mentor. So is it any one of these that you're going through right now? You have to ask yourself the question, what is the key problem that you're having? And we run an investment brokerage advisory, and 95% plus of our clients are investors. And I can tell you hand on heart, the main issue that everyone is having right now that wants to continue to build out a bigger portfolio is exactly this: borrowing power. Borrowing power is the single biggest issue in the space right now that not only our business is going through, but our clients are going through. And this is completely targeted to those people that need a solution to this and want to build out a larger portfolio. So let's go through the next slide. So why is borrowing power our biggest pain point for property investors? So investors can't get the loans that they need to keep going. All right. So if your goal is right up here, but you can only get loans to here, you're never going to hit your goals. And we've got a whole bunch of clients. I would say 80% of the people that wanted to borrow as much as they can get to build a property portfolio already have a large portfolio. Sure, there's that 20% of clients that are still going through their buying sequence right now. But these are the people that this kind of video is targeting. So let's go through a lot of the points that have happened in the industry to get us to this point. So the lending laws changed in 2018. So the rules were different in, say, 2010 to what they are now. All right. My mentor, Dave Ward in Fundy, he used to tell me in the 90s, he used to walk into the Commonwealth Bank with a deposit. They checked that he had a job and he had the deposit, and the bank manager came out with his formal approval 30 minutes later after sitting down in the branch. That's simply not the case right now. All right, the amount of documentation that it takes and the amount of checks that banks do is through the roof. Okay, there is so much compliance and checks getting done by these banks right now. So let's go through the second point. So APRA and ASIC, which are government organisations, came in and put a wet blanket on the industry. They put DTI limits in, which cap your amount of borrowing, so debt to income ratio limits. They put extra documentation requirements. They put rental reliance rules in. So there are a lot of banks that have a 50% rental reliance rule. As soon as you go over 50% of your total income as rent, they start treating you differently. So more sign-offs needed by financial planners and accountants, especially if you want to take the kind of more complex rules to take the risk off the banks and put it onto the broker and the clients. There's professional investor rules where if you go past 4 investment properties, they start treating you differently. Also some private banks that don't deal with property investors. So if you built up your wealth and you're a property investor, good luck going into some of these private banks. So you're always having to deal with the normal resi banks or the premier bank. You're never able to get into the private bank with some of these mid-tier banks. They only want to be dealing with doctors, lawyers, accountants, professional athletes, those kind of people. All right, so let's go to number 3. Banks now focus on income and servicing versus 20 years ago. Did you just have to have a deposit and a job and they would okay and tick your loan through. So that's simply the changes that we're seeing. But there's more. So let's go through some more. So banks put a 3% buffer on top of your interest rate to stress test your ability to make repayments if the rates go up. Let's go number 2. Banks cap your rent, sometimes at 6% level or around there. So even if you have higher rent than that, they won't use it for your borrowing power and your servicing. Number 3, banks have a HEM, they run your living expenses. So what they do is, if you've got 2 adults and 2 kids, they'll look at the last 1,000 applications, work out an average, and then they make that HEM a benchmark, the minimum that they're not willing to go under. So even if you're frugal and under that limit, they will always use the HEM, or what shows on your bank statement. So if you've gone on a spending spree and they've checked your bank statement and it's higher, they'll use the HEM or higher. So sometimes if you're frugal, you're getting hit with the HEM, or if you're overspending, they won't use the HEM, they'll use the higher of the two. So it's constantly reducing your borrowing power with how they look at your situation. So number 4, banks shade the rent by 20 to 30%, so they won't use the total of the rent. Some of the mid-tier banks do use a lesser percentage, but just use that as a baseline on how banks shade your income, so they don't use it all for your borrowing power. So there's more. So banks start giving you LMI declines after your third or your 4th investment property. So they don't allow you, like in the past, to just keep on going with 10% deposit deals to buy property quicker. And sure, there's 2 to 3 major LMI providers, so you could technically get 2 with one and then go 2 with another and 2 with another. You could do that, but if those banks don't meet the policies that you need to keep on going, then you're always going to get capped and you'll always get stopped, right? So if a property isn't leased, they go off the valuation report, the quoted rental amount, or the rental appraisal, whichever is lower. Okay, so they do this all the time, always going off the lower figure, which again drops your borrowing power. So what if you've got a rental appraisal at $500 a week and the agent's saying every day of the week you'll get that, but we all know bank valuation reports are more conservative and they say $450. They're going to use that $450 figure the majority of cases for your borrowing power, which drops your loan size that you can get. Okay, so you're getting the picture right. Banks continue to load extra costs and reduce the income they will use to lower their risk when they're giving you loans. Okay, the whole system is set up now to not allow people to get large investment properties in these countries anymore. So you can't build out a larger portfolio. Okay, so in 2021, when the rates were 2% at the bank level, you could get a DTI up to an 8 with Commonwealth Bank or Westpac. You could get up to a 9 with Firstmac in the mid-tiers, that's a non-bank. And you could get up to a 10 with Pepper or Liberty. All right, so I'll give you an example at the bottom. So if your household income is 80 grand and you've got one investment property, that's 20 grand in rent for that property, times an 8 DTI gives you 800k borrowing power, which is the max limit that some of the banks set. So they'll either go off whatever the bank calculator says you can get, or they'll have a max DTI limit that they're not willing to go over. So you see how powerful this was when the rates were 2%, right? Because let's say that person doesn't have one investment property. Let's say they have 5 and now the rent's at 100 grand. Okay, now you've got 180 grand income times 8, that turns into a figure that's almost double and a half that 800k figure. So a lot of people back then, when the rates were 2%, they could hit quite lofty investment goals, right? And if they went to Firstmac in the mid-tiers and they went to Pepper or Liberty in the 3rd tiers, you're building out a very substantial and large portfolio which you could hit your goals. Now the problem is the people that went down that path, and got the third tier loans. And don't get me wrong, these banks are very good banks, and they deal with, also clients with poor credit, or they don't have the trading history with being self-employed. There's a lot of gaps that those banks fill, but the problem is the rates are through the roof, right? So a lot of these people that focused on building a large investment property and going down that path, they're back then they were sitting at high 4s to the mid 5% range. Okay, but right now those rates are sitting in the 8 and 9% range, and a lot of the clients are trapped on those loans. All right, so we avoided this with a lot of our clients because we saw the writing on the wall with how high the rates were going. So we didn't do a whole lot of this style of building out a big investment portfolio. So when people have a goal of a certain amount of properties or a certain passive income target, they can reach the goals back then, right? Now it's completely different. Now rates have gone up 13 times and the borrowing power is down up to 40%. What is, only 2 years ago where this change has happened, no one is reaching their goals now by buying property in their personal name and playing by the rules unless your income is sky high. It's just not possible. You will get capped a lot earlier than what you think. And there's no such thing of hitting these 200 grand passive income targets or buying 10, 15 or 20 investment properties. I mean, even it's hard to do that right now if you're buying these 150 grand 2-bed units that you're getting, 300 or 350 rent from. Even then, it's hard to go down this path of building out a very large investment portfolio. Okay, and we don't focus on those kind of properties anyway at the moment. We do have a couple of clients that want to go into that space, but we do it very strategically. Not many clients go down that kind of path. Okay, which is why we do what we do. So kind of a huge niche of what we do in our mortgage broking advisory business is trust lending with the right property focused accountant with the right property strategy, which allows you to recycle your borrowing power and just continue going forward. All right, so always making sure that you're dealing with a property focused accountant and you're taking their advice. We are not financial advisors, all right? So you're always making sure that you have a good accountant on board, but we are mortgage brokers that are not only doing this strategy for our clients, I'm doing this for my personal property strategy as well for my investment portfolio with my wife, Maria. All right, so that's what we do a lot of. So always with trust, speak with your accountant, but you've got to understand with accountants, 95% of accountants are mum and pops that can do 1 or 2 investment properties, or they're really good business accountants and they can do a couple of investment properties. Not many accountants, unless you go to the big 4 accounting firms that have the wealth divisions and that, like PwC or Ernst and Young, those kind of accounting firms, the big 4. You're not going to get the level of advice that you really need to go down this path, and they will get in the way of the strategy and also their ability to sign off on the bank letters that are needed. All right, we do have a arm's length accounting firm that we send a lot of clients through, and all they deal with are property investors. They've got thousands of property investors on their books, and it doesn't matter how many properties you get or if you become a developer after. I also do my personal accounting over there as well, so we not only vouch for them personally, I'm over there myself, and it is arm's length. We have no interest in the business. They are just that good in the property investment space. All right, so let's talk about some of these items, and always making sure you're speaking to your accountant. All right, so with trusts, you can get an extra land tax threshold per trust in Queensland and WA, which is where we do a lot of our buys to build up the cash flow and base level of property that a client can get. All right, because the high rental yields are there, and you can get a tax threshold for land tax per trust that you have per property. So it helps you manage your land tax on a bigger property portfolio. So number 2, trusts. Recycle the borrowing power with the banks that have the right policies, and there are 10 plus banks in the country that allow you to do this kind of strategy. So we are talking about large banks in the mid tiers, and there's also one major bank that has kind of pulled out of this space right now. They've increased they haven't closed down the product, they've just increased the requirements, which don't allow you to do it right now, and they may open back up when the rates drop. All right, but there's at least 10 good solid banks, and you do get the same interest rates as residential clients. Okay, and you can go back in and revalue and do top ups and things just like normal residential clients with these kind of products. So you can hold property outside of your personal name because you're in a trust, which protects you if you get sued or have a high risk job. So when you speak with us and your accountant, we will talk about who the trustee should be and what type of trust you should be setting up, and that will all be talked about. And I'll use personal examples of what I'm doing and get you to speak with the accountant as well. So yeah, if you're in a high risk job and you think you might be getting sued, or you've got a high risk job where that could be a potential, holding property outside of your personal name is also an advantage because it protects that property. So you can still gain access to the 12-month holding rule for 50% capital gains tax discount inside of a trust, which is great. So if you ever choose to sell in the future, you get access to that. And also with beneficiaries of trusts, you can do all these inventive ways on who the beneficiaries are, which helps you reduce your tax as well inside of trusts, which is what I do personally. So always making sure your accountant knows everything and you're taking direction of an accountant. So number 5, reduces your tax level down to the 30% trust level. Can be very advantageous for high income earners on the 49% tax bracket like myself. All right, so if you build yourself up and you get to 5, 10, 15, 20 investment properties, and you start paying down the debt, or you hold the properties for 5, 10 years and then sell 5 of them to clear the debt, suddenly you've got all this income in the world, but it's being distributed at a 30% level inside of a trust, which is and there's all these different ways that you can funnel money into other trusts and buy other property or commercial property, or also shares and things like that as well. But that's a very high level once you start building out a larger portfolio. All right, but let's go to the next slide. But you want to make sure this matches your goals and objectives, right? Which I completely get. So you could max out in personal name, then buy 1 or 2 properties in SMSF, your self-managed super fund. Then you could buy through commercial lease stock products with 30 to 40% deposits. So you could wait for the rates to come down to that 5% range where these products work, and then they exclude all of your, let's say you've got 5 investment properties, they move it all to the side, and they only look at the strength of the tenant, how good the rent is, and how good the lease is. So that's a very good way to buy property, but you are looking at much larger deposits. So some people don't like that, and with what happened in the office space for commercial properties, a lot of people think that commercial properties are higher risk as well. We mainly focus on the industrial properties at the moment for clients in this space. All right, so that might be suitable for you. Then you wait for the rates to drop and you buy 1 more property in your personal name. Then maybe you get a job pay increase and you can buy 1 more. Then you can pay off, some of the debt and buy 1 more in 5 to 10 years. So you have to sit down and ask yourself, if your borrowing power is here and then you go through this list and you can maybe be able to get 3 more properties, are you happy with that? Will that match your goals? Will that get you to where you want? And main thing is right now, a lot of the property investors, the answer is no, that's not going to get them where they want, and they don't want to do these large deposits. And really right now where the rates are at 7 or 8%, or let's say just 7%, these lease stock products don't work. They keep forcing you to do a full doc, and then if you've got a large investment property portfolio, a lot of the time the deal doesn't service. So for you to buy a lot of commercial, you've got to be going and doing larger deposits, or finding these really fringe products. All right, so you have to ask yourself, does that match my goals, or do I want do I want a control of my borrowing power and do it in the timeline and sequence that I want, not what the bank forces me to do? Because what you notice is if you buy in personal name or joint names, you're constantly allowing the bank to dictate the times that you can get more lending. So when their lending eases, you can buy more. When the rates drop, you can buy more. When your income goes up, you can buy more. You don't get to dictate that pace, right? Once you max out on your borrowing power. So with trusts, you get a lot more control over dictating the pace and the sequence that you want to go in. All right, but isn't this just for the high income earners? And a lot of people will say that to you. And I've got to be very honest. There's a lot of people in the broking space that either don't have the experience, they haven't done this personally, they don't have a lot of clients doing this, so they make knee-jerk statements with that they can't really back up. And there is no income requirements for this. So we have some clients on 80 grand doing this, and we have some clients on household incomes over 300 grand doing this. The key thing is it has to match your goals and what you need. And I don't know your personal circumstances right now, which is why this is general in nature. But yes, we do have clients at 80 grand income that are using these strategies, all right? So as long as you've got your first deposit and you're ready to go, you can start doing these kind of things. All right, so let's talk about me. So you may have seen me on the Major Investment Property Podcast, Pizza and Property Podcast, Smart Property Investment Show, Oz Property Investors Facebook Group Podcast. I've documented my whole journey. Or I've got 90 plus videos on YouTube or on LinkedIn. I've been active for 5+ years, so a lot of people know me from there. I'm 14+ years in lending and finance. It's all I've ever done. I own currently 9 investment properties with my wife Maria. We use these kind of trust strategies in my personal portfolio. So we're on target right now to buy another 3 to 5 investment properties this year. We've got over 100 plus clients using these kind of strategies, using trusts, and I could be fully income replaced within 4 years of buying my first investment property. And yes, that is all documented, all real and all true, and there's a lot of information online and videos that I've done and podcasts that I've been on that I've shown my progress. So you can go and check all that social proof out there. Okay, so yes, you heard that right. If I put all my granny flats on this year, which is my 4th year of buying, I could be fully income replaced. And we have many clients going through this process as well. So how many people in the country can say they did this post 2018 lending laws and disclosing all their information? Most are hiding either a silver spoon or a much higher income. So let's talk about me. So max income to 7 investment properties with an 8th pre-approval was 210 grand for my wife and I. And just bear in mind I'm self-employed, so it's not the same as 2 salary workers, so I can claim a lot more expenses and making sure I'm doing everything right via my accountant. So there's no silver spoon, no help from family, no living with family, no help with deposits from family, nothing. We rent vested for 5 years while building the business up and putting all the money into investment properties. So we could have gone and bought that $1.5 million house next to the parents. And right now we'd be in mortgage stress if we did that. So we chose to do things the opposite way to how society teaches you, and via delayed gratification, and look at where we're at right now compared to the majority of our peers and the population. So we had old cars, a Suzuki Swift 2007 model and a Toyota Camry 2005 model. We didn't upgrade till 2023, so we were completely fine driving older cars. Went to a $50 to $60 meal at a Japanese sushi restaurant in South Sydney. Made sure that we were there during happy hour where the beers were cheaper. And we delayed having kids for 4+ years while we went through all of this of building up the business and buying the investment properties. So the first baby should be coming in about 3 to 4 months' time, which is exciting. So no credit cards, no personal loans, no car loans, and our rent during that time was between about $410 to $430 per week for that period of time. Now, my income doesn't have to go up for me to continue borrowing and buying investment properties. As long as I have my deposit and or equity plus my financials stay around the same, plus the rates don't go up another 2%, I can just keep on going. So we talk about clients and fully unlocking our clients' borrowing power, where they're just able to keep on going and recycling their borrowing power. So yeah, my income's going up, don't get me wrong, but my income doesn't have to go up for me to continue borrowing. So that's the beauty of trust and how we set things up for our clients. So we also have a buyer's agency where we love equity uplift strategies to get 50, 100, 150 grand uplifts. You know, we do things like bedroom conversions. We like adding 3-bedder granny flats instead of 2-bedders because we know the town planning rules better than the other people that are bidding on the properties. Well, we love double granny flat sites right now. Again, a lot of people think you can just put one granny flat on some of these areas. We can actually fit 2 because we've got town planning software. And same thing with strata titling. So we like having some sort of advantage where we know that you can do things that other people don't know about, which enables you to get these kind of 50, 100, 150 grand uplifts, you know, just for a simple buyer's agent fee. And obviously that fee is tax deductible as well, so it adds to the cost base of your property. So if you ever sell in the future, your CGT or your capital gains tax is reduced. But always double check what I'm saying with your accountant, right? I just know this because I'm doing this on my personal investment journey. All right, and we've got a lot of clients doing it as well. So we explain where we're buying and why. We send you a full data and analytics report. We do all the checks for servicing and town planning. We do the flood checks and mapping. We do insurance checks. We do connect you with the right professionals like granny flat builders or property managers. And we also have a cash flow model as well, where we can model out the cash flow for the property that you're buying, and also run a cash flow modeling sequence, which allows you to see that if you buy these properties in these sequence, you can hit this passive income target, which not many other people have in the industry. So we're able to do that for you through the buyer's agency if you need it. All right, so if you want to chat to a property-focused investment mortgage broker, you can book an appointment below in the calendar link below. I'll put a link in the first comment, and I'll put a link in the box below. Book straight into my calendar, and we're very excited to help a lot of people to achieve their goals in property. And my name is Adrian Player. I'm the head of finance in Fundy, and we only focus on property investment and driving results for our clients. All right, so hit the like button, hit the subscribe button, leave me a comment below, and we will see you on the next video, or I'll see you on the next call in my calendar. You have a great day. All right then, bye.